Van, I mean, let's dig deeper then into some of the fiscal consolidation measures. Do you think that they're going to be enough to get the credit ratings to boost their outlook?
Well, we believe they are more than adequate to get a credit rating upgrade. We have demonstrated commitment to fiscal prudence and the fiscal glide path, which the credit rating agencies thought would not be pursued. And we have shown that we are committed to the path. And the Honorable Finance Minister also specifically reiterated her commitment to achieving 4.5% fiscal deficit ratio in FY26. So I think there is enough in the budget to signal the government's commitment to the path of fiscal prudence and stability. And I think I hope the credit rating agencies will indeed take note of them.
What about opening up the nation's public finances to greater scrutiny? There is the possibility that comes with greater volatility on behalf of foreign investors in particular. What measures are you taking to offset the impact?
The Finance Ministry publishes monthly accounts of how the actual spending progresses in comparison to the budget. We have data for the first 8 months of the current financial year. If anything, over the last 6 years, if you even read the commentary by analysts and new media commentators, the transparency and the prudent assumptions that are being made, whether it is with respect to revenue buoyancy or, for that matter, the nominal GDP growth assumptions, etc., all of them have come in for deserved praise for their conservatism and prudence and transparency. There are no below-the-line items here. So I think the government budgeting process has stood up to scrutiny and has come out well with flying colors. Back to you.
The disinvestment targets, though, Van, have been missed for several years in a row. And I look at an Indian equity market that is flying at all-time highs. There aren't really a lot of excuses out there for why those targets have been missed. What's the holdup?
In the absence of, there are two things here. Privatization is one thing, which is also to pass on management control. But if purely disinvestment should not become an exercise of revenue generation that can be obtained through better performance and management for public sector enterprises and collecting dividends from their improved operations. That's exactly what's been happening. If you look at the reason for non-debt capital receipts to exceed the budget estimates, it's precisely because of the dividends not only received from the Reserve Bank of India, but also from public sector enterprises, including banks. So when they generate value and are able to be profitable and declare dividends, now money is fungible. Whether it comes in as disinvestment receipts or as higher dividends, that shouldn't matter.
You've got a massive grasp on capital flows and what's moving where. So I want to leverage that and understand where you're seeing the biggest inflows into within private investment, because that continues to be low. What are some of the highlights there, and where is it coming from?
So the foreign direct investment may be somewhat lower than the previous financial year, but in the last 2 months, basically for which we have the data up to November, October and November, there have been a significant pickup in foreign direct investment flows. Earlier, it was not as if the foreign direct investment flows themselves had declined meaningfully. It was not the case. It was that the repatriation of earlier investments that made the net investment number look a lot lower. But that repatriation, in a way, wasn't exactly capital leaving the country, but some of it was picked up by portfolio investors. And that is why if you look at the portfolio investment flows for the current financial year, they are north of $30 billion. So in that sense, the investor interest in the Indian markets or the economy haven't waned. And UNCTAD also publishes his annual World Investment Report and points out that new greenfield investment announcements with respect to India are far higher for the coming calendar year, as for this calendar year and next as well.
Okay. There is a reality of a weak consumption backdrop, and I'm wondering about the kind of conversations you're having at a very top level of government around ways to boost that. What's on the table? What's going to get executed on in the next few weeks?
Consumption boost comes through employment generation and income growth, and that's exactly what the government has been focused on, nursing the financial sector back to health so that it could lend for businesses. And if you look at the rate of credit growth, excluding personal non-food related credit, excluding personal loans, is running at about 13% plus. And that's exactly one way of keeping economic activity humming to be able to generate jobs and income growth. And then the government announced last month that the Pradhan Mantri Garib Kalyan Anna Yojana, which is the free food program, has been extended for 5 more years. That also puts more money in the pockets of households, boosting their disposable income. The construction sector is coming back. Basically, the interruption caused by COVID in terms of reverse migration into rural India is now reversing itself again. And you will see in the coming years, manufacturing employment picking up.
The RBI is set to meet next week, and they are going to be discussing some of the cost pressures. The signaling from the Federal Reserve is going to play into some of those debates. I'm wondering if you had a seat at that table, what would you be telling them about what needs to be done through the next quarter?
Who's meeting next week, please?
The Reserve Bank of India. Yes.
Okay. So, well, I normally don't comment on monetary policy matters in public. They know best, and they have been steering the monetary policy quite competently over the last several years. So they know what best to do in order to keep both macro stability in mind, economic growth, and fiscal and price stability as well. So we have full confidence in their ability to assess the economy and take appropriate action.
Okay, so you don't have anything to add beyond that in terms of recalibrating or prioritizing anything?
Well, I don't discuss monetary policy in public. That is their domain.
Yeah, well, I thought I'd try and push you on that. All right, talk to me then about the impact from the Red Sea conflict on trade and inflation. Maybe you could tell me a bit more on that.
Well, I think it's still early days for us to be able to assess the implications for input costs, input prices, and also on final end consumer prices. There is an impact, but it could probably be absorbed in some cases. And India has been in the forefront ensuring that the sea lanes are open and safe. And the fact that the underlying price of raw materials has also been declining, and your screen showed that crude oil declined 5.5% during the week, etc. So that offsets some of the pressures coming from this. So it is still early days to speak about the macroeconomic impact of the Red Sea turbulence on India's input cost and inflation outlook. The inflation outlook is that the overall inflation rate will be coming towards the central bank's target in the second half of the upcoming financial year.